All right, everybody, welcome back to another episode of the Discovering Multifamily Podcast. I'm one of your hosts, Anthony Scandariato with Red Knight Properties. And today we have a special guest here with us, Vessi Kapoulian. Did I say that right?
Kapoulian, yes, very close.
Kapoulian. I know we went over this before, but I tend to butcher it. Awesome. Well, Vessi is joining us. She has over 18 years of business experience, and that includes 14 years of commercial lending, real estate, business experience. And, she's professionally been working in, real estate space for a while. She actually started investing in 2017 into real estate. About 6 years ago at this point, and she's got properties in Florida, Tennessee, Georgia. I think she has 6 properties right now. And, she is active in various, real estate networks. And, she speaks at different meetups. And, she's kind of involved in moving forward the underwriting process for a lot of investment opportunities in 2023 and beyond for commercial multifamily properties. And today we're just going to kind of talk about what she's seeing in the market, how she is changing, if she's changing her underwriting, basically meaning her evaluation of acquiring commercial real estate for multifamily. So thanks so much for coming on.
It's a pleasure to be here. Thanks for having me, Anthony.
Great. Could you talk to us about some of the properties you own, if you sold any of them, and kind of what you're looking to do moving forward in multifamily?
Absolutely. I would describe myself as a net buyer. Have different verticals, one being a residential portfolio, one being the multifamily portfolio, and then a third stream of passive investments. And I apply the passive investment opportunities outside of multifamily and residential just as a way to diversify my overall real estate portfolio. But specifically in multifamily, I pursue both JVs, and those are for smaller properties, 5 to 10 units. Anything larger typically requires a little bit more work and a little bit more capital, so those are usually syndicated. And naturally with syndications, those are more or less medium-term flips, so eventually you do sell those. But as far as the residential portfolio and the JVs, I would describe those as forever buy and hold. So overall net buyer.
Are you still a net buyer in 2023?
I want to be. I am continuing to look at deals, and I still believe in real estate in the long run. We are going through a cycle right now, and no, prices don't always go up. There are always cycles, but in the long run, I do believe in real estate and all the additional benefits it offers. So I'm continuously looking at properties. However, it has become increasingly challenging for those to pencil in, and we can dive into that as well. So haven't purchased any, but look to continue to buy as long as the numbers make sense.
Okay. So let's dig into that. What's been more challenging? I mentioned you're in 3 different markets. Are you only trying to expand in those markets, and is it just an inventory problem? What are the challenges?
Well, there are a number of challenges, and specifically for acquisitions, I focus on Florida, Tampa, Jacksonville, and Orlando. So that's my primary focus. There are a few things that have changed. One is the interest rate environment. We're all reading the news every day about inflation and the Fed's priority to tame that by increasing interest rates. And they've been rapidly rising since pretty much March of last year, and likely to continue to rise at least in the beginning of this year, until we get a grasp on the inflation readings. And if you think about the capital stack of a deal, the lender is your largest partner typically. So naturally, the cost of lending increases, impacts the returns and the structures that we're looking at. In addition to that, rents have started moderating in a lot of markets, and actually in some markets declining quarter over quarter. We're not seeing year over year decreases yet. But certainly as I evaluate deals, I'm not as aggressive, and in some cases forecasting flat rents year over year, or if the market warrants maybe a slight decline, just so I can maintain a more realistic view of how the asset will perform, at least in the short run. And then in the long run, normalizing that growth more closely aligned to the historical trend versus the anomaly we saw over the past couple of years. But rents are impacting naturally the bottom line. It all starts with the top line, so that's also leading to return compression. Vacancies are also increasing slowly and due to a number of factors, but again, depending on each market or sub-market, in some places we're even seeing negative absorption because a lot of household formation is slowing down, or people are leaving areas that are less affordable. So that's also putting some pressure on the top line. And then on the expense side, specifically what's happening in Florida, and I think Texas is another state that I hear my colleagues mention frequently, is the exorbitant cost of insurance that's continuing to rise. And it has been rising over the years, but especially in the last year with Hurricane Ian. When I look at deals, if I find one that pencils in, if it's close enough, I definitely get a quote from my insurance broker, and then I keep checking periodically because it is not uncommon at all for prices to change up until closing the deal, and that could be 100, 200 per door impact on your P&L, which is pretty significant. Of course, the continuous property appreciation has resulted in higher assessed values, naturally leading to higher property taxes. And that's another big chunk of the expenses impacting the bottom line. And last but not least, cap rates. Interest rates have started increasing. We are seeing cap rate reversion in some places more rapidly than others. Now, how far will that go? I don't know. I don't know if we'll see 8% cap rates or even 7%, because there are also some supply considerations there. But that's certainly impacting deal decisions, because when rates are 6-7% and cap rates are still in some places around 5%, then you're looking at negative leverage. And previously, people were able to offset that in the short run by the rapid rise in rents, but that is not happening anymore, effectively leading to subpar returns that are not enough to for the deal to pencil in or attract investors.
Right. And you mentioned you're in 3 markets, so Florida, Texas, and what was the other one?
So Florida, Georgia, and Tennessee, and I specifically for acquisitions focus on Florida. My other deals there, I got in through underwriting and helping those syndicates or teams.
Okay. My apologies then. So in Florida, what markets in Florida are you in, and do you still want to continue focus on expansion there? Some of the coastal markets, our company personally was in them, that got hit by hurricanes and higher insurance. Ended up doing really well on the deal. But I'm hearing we've kind of, I wouldn't say taken a pause at Florida. We've just certain areas we're staying out of now. What markets are you in Florida? You know, on the insurance side, that seems to be really impacting deals. Basically, deals are at a standstill from everything I'm reading and having discussions with brokers daily.
Yes, I mean, the insurance is impacting deals, I would say, across Florida, but the 2 markets I have properties in are Orlando and Tampa. So certainly, I would like to continue to look for deals there as long as the numbers make sense. But given some of the challenges with hitting returns, I'm certainly keeping an open mind and open to looking at deals elsewhere. Now, I think it's important to maintain focus versus jumping around from market to market. So usually when I close on deals outside of my core market, I partner with people who are there, boots on the ground, possibly even sourcing those deals, but I act as that either second set of eyes on vetting the deal, the numbers, and or doing the full underwrite on the deal. So I'm certainly open to expanding the footprint outside of Florida, given the challenges, but at the same time, the long-term fundamentals for the state are strong, so I would like to continue to expand there, albeit at a slower pace until the numbers pencil in.
Excellent. And so in terms of underwriting, you mentioned interest rates and rents moderating. Have you seen any changes to the debt structure that you're looking at? Because you mentioned long run. What does long run exactly mean? Is that 5 years, 7 years, 10 years? How are you trying to offset some of the headwinds that are coming, into play, into 2023 and still make wise investment decisions? Are there different strategies you're trying to look to now, but still focus on multifamily?
Yes, so definitely when it comes to debt, looking at fixed rate debt, medium term holding, medium I define as 5 years. That's, of course, nobody has a crystal ball, but I think it's a long enough period to where you can weather the storm in the short run, whether it lasts a year or two, and giving you enough of a runway to execute on your business plan, preferably low or no prepayment penalties, and that really varies by lender, so that gives you the flexibility to refinance when rates go down in the long run, or in the medium term, I should say, within the next 2 years or so. But definitely avoiding the volatility of rates by getting that fixed. There are fixed rate bridge loans, and those might make sense for certain deals, but I'm not super eager, because those typically have a very short tenor and the extensions are not guaranteed, again leaving you exposed in that medium 3-year horizon, where I think probably where most of the risk would be.
Right. Yeah, it's definitely important to have flexibility in your loan structure. What size you mentioned syndications and you mentioned JVs. Can you explain the difference between the two in terms of the size range of your deals you're looking at?
Yes. So for JVs, typically you have a couple of partners they're all actively involved. Those deals are smaller, I would say 5 to 10 doors in the multifamily space. Around $1 million, $1.5 million would be the kind of the price point. And it's still enough work for everyone to get involved. Anything larger requires a little bit more work. So over 10, 15 units, those are typically syndicated, and those require, of course, a lot more capital, which makes it then more appropriate to bring passive investors who don't want to be actively engaged managing the deal.
Yeah. And how are you sourcing both opportunities, both the JVs and syndications?
So in my market, through brokers, that's what I've decided to focus on, because roughly 92 to 93% of the deals come from brokers, and I still have my W-2 job, so that's a little bit more manageable. Another way I get involved in deals is through underwriting. I've helped, as I mentioned, other teams, and that's how we closed on the deal. For example, in Georgia, I didn't necessarily source that, but I was able to find a way and add value to that team. But in my primary market, it's through brokers.
Got it. And is there like a guide or some sort of template that you use to help guide your investment decisions for underwriting?
Yes, when it comes to return criteria, starting with the end in mind, right, and the investor requirements, I start with the returns. That's and those are consistent with my own personal investment guidelines. Again, for JVs that tend to be forever buy and holds, I would say 8 to 10 cash on cash return, preferably closer to the 10%, which again is very challenging to meet in the current market, but that's okay, because I'm not here for a day or two. For syndications, I would say 15 to 20% IRR, 1.5 to 2 equity multiple. Those will be the driving factors. is where I start from. And of course, the most important is the market and sub-market. So I stay away from Class D areas, Class D properties with violent crimes, mostly focus on B, C plus, stable value add, no heavy lift type of areas, properties. And at least at this stage, I'm mostly focused on market multifamily housing versus other asset classes like student housing, assisted living, condos. I'm not touching any of those at this stage.
Right. No, that's great. And when you mentioned you helped with the underwriting for a deal in Georgia, can you kind of talk about it? Do you run different scenarios in your underwriting where it's okay, if I hit these types of rents, here are the returns, and then to follow up with that, moving into 2023, have any of the return expectations from yourself or from any of your partners changed? Because you could buy a 10-year or you could buy a 5-year treasury note at close to 4%, risk free. So
Right. Excellent. You nailed it. So I guess I'll tackle the first question. As far as the underwriting, we were very conservative in our estimates and definitely ran sensitivity analysis. Also, one metric I like to look at is the break-even occupancy. And for that property in particular, it was under 80%, just under 80%. So that leaves you a lot of cushion for things to go wrong, if they do go wrong. We were more conservative in our rent estimates, and so far we are exceeding those. And in that particular market, even with my other deal, there's very limited supply of apartments. And when we purchased the properties, all the units were well under market. So that gives us a big runway. And so for that property, we are exceeding projections. But again, it started with a very conservative evaluation, not buying the property at negative leverage. And that's what I think, and having ample reserves. So cash and cash flow, that's the biggest focus. So I think that's been very helpful in as far as us outperforming projections, at least to date. And then the second question, I apologize, I forgot.
have any of your partners or investors return criteria changed?
Yes. So definitely, I mean, people have options, like you mentioned, getting 4% and keeping cash with the bank at the bank. So so certainly they're not necessarily reducing their return expectations. I do think in the short run we will see compressed returns, and that's what will likely keep a lot of people on the sidelines for some time. So so from that perspective, their criteria have not changed much as far as expectations, and now they have other options, like you mentioned. So they're definitely being more cautious and evaluating those risk return options.
Thanks. Oh yeah, that makes a lot of sense. And great. Well, I'm gonna wrap this up. How can my audience find you, learn more about you?
The easiest way to connect with me is through my website, www.dbacapitalgroup.com. D as in dream, B as in believe, A as in achieve. My phone, email, Calendly link are there if people would like to schedule a call. And I just released my first digital book, The Busy Professional's Quick Guide to Investing in Multifamily, really designed to empower and educate investors while giving them quick, easy to digest information that they can fit in their busy schedules.
Awesome. Well, I look forward to reading that, and I can also provide a link to the website and the book in our social media descriptions and on our iTunes description, so everyone can go check it out and reach out if you want to connect with Vessi. You know, like she just said, that's a way to reach out and connect. And if you liked what you heard and or saw today, please give us a rating and review on iTunes. It helps our message get out to a greater audience. And really appreciate your time, Vessi, today, and look forward to staying in touch.
Great. Thank you, Anthony.
Thank you.